Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing JetBlue stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. JetBlue is a low-cost airline and the 7th largest airline in North America. Its headquarters are in Queens, New York. It was founded in 1999. The company started by following Southwest's approach of offering low-cost travel, but they wanted to distinguish themselves by offering amenities such as in-flight entertainment, TV at every seat, and Sirius XM satellite radio. JetBlue operates over 1,000 flights daily and serves 100 domestic and international network destinations in the US, Mexico, the Caribbean, Central America, and South America. The company is not a member of any of the 3 major airline alliances, but it has codeshare agreements with 21 airlines. Let's get started with the model. This is a mid-cap company, 4.6 billion market cap. They're trading at $14.69 a share, and they have 314 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company had positive free cash flow every year except for the trailing 12 months, mainly due to COVID and low travel. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also have positive every year except the trailing 12 months. Revenue is a sales, and it grows nicely from 2017 to 2019. Then it's cut in half in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses that are directly related to generating the revenue. Revenue minus cost of revenue is gross profit, and that was negative in the trailing 12 months due to low sales from COVID. In prior years, it was around $2 billion. Then they have operating expenses, which they did a good job of cutting in the trailing 12 months. They had negative $600 million of operating income, and they did have a nice positive in prior years. The company has a bit of debt, so they have $128 million of interest on their debt. Then other income and expenses. Their pre-tax income was negative $1.2 billion, but they did receive a $341 million tax rebate. So their net income was negative $820 million, much worse than prior years. This is the statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Most of their CapEx is airplanes. Operating cash flow minus CapEx gives you your free cash flow, and that was negative $1 billion in the trailing 12 months. But positive in prior years. This company does not pay a dividend, so they were buying back stock. That's another way to reward investors, because when a company buys back stock, it lessens the shares in the market, making the current shares worth more. They bought back $400 million in 2017, another $400 million in 2018, $540 million in 2019. The company didn't use too much debt to run their business in 2017, 18, and 19. But in the trailing 12 months, they took out $4.5 billion of debt. They did repay $1.3 billion, so they added over $3 billion of debt that year. Obviously, they need this debt to run their business since they had negative $1 billion of free cash flow. Also, the company probably wants to have a good amount of cash on hand in case the pandemic lasts longer than expected. The most important part of any business is their operating cash flow. And they do have positive operating cash flow each year. Even during a really difficult year, they still managed to squeak out a positive operating cash flow. And the way you calculate operating cash flow, you start with net income that was negative $820 million, and then you have to add or subtract the non-cash items from the income statement. They had $547 million of depreciation. There was a tax credit of $299 million. We have to reverse that out on the cash flow from operations section. There was also an asset impairment of $258 million they took a loss for. We have to add that back on a statement of cash flows. An asset impairment is when the value of an asset is less than the value in a balance sheet. So you have to reduce the value in your balance sheet and pass through a loss onto the income statement. Also part of the CFO calculation is changes in working capital, and that was positive $140 million. Let's look at a capital structure. $4.8 billion of equity, $3.2 billion of debt, but they have $1.8 billion of net debt. Net debt is debt minus cash. So 60% of that capital structure is equity, 40% is debt. Their WACC is close to 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year for that's $6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.6 billion. We divide that by 314 million shares. We get a calculated stock price of $14.60. They're trading at $14.69. So my calculation is pretty much where they're trading at. This may be the closest my model's ever been to a company's stock price. Simply Wall Street values the company at $24, so they're saying it's undervalued. They're saying it's a strong buy. But you have to remember, the stock price is not always based off of what the company's worth. It's based off of what investors are willing to pay. The stock price is based off of supply and demand of the market. If the market feels the stock is worth $24, they will push the price up to $24. If they feel it's worth $10, they'll push the price down to $10. Since the market is forward thinking, sometimes investors look towards the future, even if the future is not in line with what the company actually did in the past. So you can see the stock was pretty steady for a few years. Then it dropped like everything else in March when the market crashed. It has come up a bit, but it's still trading at a pretty nice discount relative to its all-time high, and a really big discount relative to what Simply Wall Street says, but it's trading at intrinsic value according to my model. If you ask 10 people what a stock is worth, you will get 10 different answers. That's the fun of the stock market. The company has a beta of 1.57, so the stock moves 1.5 times the market. It's gone down 21% in the past 52 weeks, much worse than the S&P 500, which went up 16%. The 52-week low is 661, the high was 2165, and the stock is trading above its 200-day moving average, but below its 50-day moving average. About 8 to 10 million shares are traded each day for this stock. Of the 314 million shares outstanding, 271 million are on float. Institutions appear bullish on this stock since 70% of the shares are held by them. More than 5% of the shares on float are shorted. If you invested $10,000 in this company 10 years ago, you'd have $21,000 today. So if you invested $10,000 in January 2011, your investment would have been down to $9,000 or $8,000 right off the bat, but then it would have increased a lot if you held it, and you could have sold it at $35,000. But if you're still holding, you're at $21,000. Still a good return on investment. FMR is the biggest shareholder at 9%, then Vanguard at 7.5%, BlackRock 7%, PrimeCap, then Dimensional Fund. Let's look at the financial ratios. The average PE in the market's 11.9, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. So if we looked at the PE ratio last year or the year before, they would have had a positive PE because they had positive earnings. But since the trailing 12 months, they have negative net income, they have negative PE. Price to sales is stock price over sales per share. They're at 1.1, so they have a great price to sales ratio. That means investors are paying $1.10 for $1 of revenue. Price to book is stock price over book value per share. They're at 1.0, much better than the median average. This indicates that if the company went bankrupt today and sold all its assets, paid off all its debt, it would still be able to give each shareholder $15.26, which is more than what they're currently holding, $14.69. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have a negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can only cover 70% of their current liabilities with their current assets. Their current assets are $1.3 billion of cash and $231 million of receivables. So it does look like the company will need more debt to run their business over the next 12 months because they had negative free cash flow and in working capital is negative 877 million. Working capital is current assets minus current liabilities. The best way to look at ratios to compare them is similar companies. I've done videos on American Airlines, Air Canada, Alaska Air, Copa, Delta, Exchange Income, Southwest, Spirit, SkyWest, and United, all in the same industry as JetBlue. And if JetBlue has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they have negative. They're doing a little worse in price to sales. They're doing much better in price to book. They have a terrible current ratio, terrible ROE. They're lower in debt than average. Market cap there at 4.6 billion, average is 9.1 billion. And they don't pay a dividend. So to summarize, I have them trading at a 1% premium. But JetBlue is a great airline, just like Southwest. I think those are the two best airlines out there. So for a long-term investment, I don't think you could go wrong with JetBlue. But for a quick flip, it might not be the best investment. Of course, all the airlines are struggling in 2020 and possibly 2021, but I'm pretty confident by 2022, airlines will be back to where they were in 2019. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.